What's up, everyone? Are we ready to do this again?
Yes,
So
sir.
here's what we're going to do. This is still an experiment for now to figure out the format of it all. So what I think we're going to do different this time, based on a little bit of feedback from the first one, is we're going to discuss for maybe 30 or 40 minutes the topic of keeping calm in a turbulent market. And then after that, we're going to separate from the topic and do an open floor so anyone can talk about any topic whatsoever. There were a few comments last time about how we were kind of going all over the place on topics, and we were. We had some good comments, we had some bad comments. So again, this is just an experiment to figure out what the best way to do this is, that we all basically have a voice and we all have some fun sharing some information and hopefully learning some stuff from each other. This is not a lecture from me to you guys. I do like participation from everyone here. If you're shy and you just want to listen in, that's okay too. So right now, everyone is set to mute. So the way it worked great last time is if you go to the top corner of your screen where you have some controls, there should be a section there that says raise your hand. So what we're going to do is basically have a little conversation here. And if you have something you want to say and jump in, hit that button that says raise your hand, and then I can call upon you and you've got the floor. Everyone else, please stay muted so there's no background noise, there's no music, there's no news channels going on. We want it nice and quiet as best we can. And then when you raise your hand, I'll call upon you, give you the floor. You can unmute yourself, or I can unmute you if you can't find the mute button. Say what you need to say. Educate us all, share some comments, thoughts, opinions, whatever, and then go back on mute when you're done so that we can have the floor open for everyone else. So basically, everyone here has a chance to talk and participate. The more the better, because the more people that participate, it's just the more experience we have in the room that we're sharing with each other, and the more opinions we're going to have. So if some people disagree, that's awesome, because it's going to give us kind of a view from different perspectives. And that's what this is all about, for a bunch of retail traders to kind of stick together and just figure out how we can do this in such a way that we can beat the machines at their game. So the topic is keeping calm in a turbulent market. So far, before we even start, there's one person having trouble finding the raise your hand button. Does anyone else know where it is? Is everyone else confused? You found it, awesome. Okay, so there is a chat room. For those of you that are new to the software, there's a chat room where you can type in there as well. And again, the format is going to be a few minutes, hopefully 30 minutes or so. We can all get an opinion on keeping calm in a turbulent market. And then after that, we're going to open the floor for any random topic you have about trading. It can be trading, it can be strategies, it can be what's working for you, it can be something you're struggling with. So to start off, welcome to the Retail Traders Roundtable. This is the second time we're doing this. We had a lot of fun last time. There were a few people that said we should do it repeatedly. I'm sure there are some people that didn't like it and didn't respond, but there's enough people that said, let's do this again. So I think right now we're going to do it every other week and see what we can do as far as making this kind of a repeated Sunday night event where every other week we can get together and share some thoughts to help make us all better traders. So tonight's topic is keeping calm in a turbulent market, because the last 2 weeks we've just seen the most ridiculous action in the market that we've ever and probably will ever see again. So I want to go over some things that's working for everyone that we can share. If you're struggling, listen in. Hopefully some people here have some advice on how to survive this kind of a market and how we can not just survive, but excel. There's two things I'm going to start this conversation with, and then I'm going to pass it off to anyone who has a question about what I've said, or anyone else who wants to bring up a new, same topic, but a new perspective of it. So please, for the first 30 minutes or so, let's all be mindful of what we're trying to discuss here, which is keeping calm and surviving in this crazy market. If you have questions or comments on stuff outside of that topic, we will do a second session after this where we can go to an open forum. So to start with, first things first, the way I'm basically keeping calm And this might work for some of you. Maybe some of you don't do this and you have to figure out how. The way I'm keeping calm is my main strategy that I do not have any kind of a bias. So people are asking right now with the futures, they hit a limit down and everyone's saying, well, where are we going to open tomorrow? And for me, the thing is, I don't have a bias. Where are we going to open tomorrow? I don't know. Not only do I not know, but I don't care. If we open down, we'll figure out what to do then. If we open up, we'll figure out what to do then. If we open down and give it back, that's a possibility. It's a possibility we open up and then give that back. So I don't go into the market with any kind of a bias as far as what should happen tomorrow, because what I think would or should happen just doesn't matter. It doesn't mean it's going to play out that way. So for me, and it's easy for me to do this because I've had a bias and gotten burned on it multiple times. So over the years, I've learned to just not have a bias. So I hate answering certain questions when people are like, oh, I'm in this, what should I do tomorrow? And it's like, I don't have a crystal ball. I can't see the future. So no one can tell you what to do tomorrow until we see what happens tomorrow. Now there's a very negative sentiment. So a lot of people are expecting things to just plummet. But what if tonight they opened up and said, hey, you know what? Democrats and Republicans came together. We've got a stimulus plan. We've all agreed upon it. You're probably going to see a pop tomorrow. Now, whether that's sustained or not, who knows? So as of now, what's going to happen tomorrow? We just don't know. So for me, it's just a matter of I don't have a bias until the market opens. And once the market opens, I can see the price action and figure out what's going on from there. So how am I surviving personally is just not having a bias, not thinking about this is going to happen or that should happen. It's waiting to see what's actually happening once the market opens. We can all have an opinion on up or down, but what doesn't lie is the chart. The chart is telling you people are buying or people are selling. That's not an opinion, that's what's actually happening. So for me, the best way to manage a market that's up 600 points one and down 1,000 points the next, it's just to not have a bias. Focus on the charts, focus on what's actually happening. The other thing I'm going to say before I pass this along to everyone else here is that one strategy, if you're getting killed in this market, let's say you've got a 401k and you've got some long positions that you didn't close out of, one thing you can do is take some shorter term positions as a hedge. So let's say you have 5,000 shares of Microsoft. And Microsoft is plummeting, but it's your 401k and you didn't close them out and you're still holding them and you think it's a great long-term play, but you're in them now worried about how much they're eroding. What you can do is buy some shorter term puts to capitalize on making money as they drop, still holding that stock position that you might have with maybe a 20 or 30-year time horizon. So that's one of the things some people forget about. It's if you're using options as a hedge, that works out. You can still hold those longer positions and just use shorter term puts to hedge for the downside, make some money while it is dropping without giving up the long side. But I do know a lot of people that obviously dumped out of and closed all their long positions and they'll look to pick them back up at better prices. But for those of you that are still in longer term positions that haven't closed them out, that's one strategy you can kind of keep track of. If we're having super bloody red days and you're just not convinced you're going to give up those long positions, or maybe they've dropped so much now that you're just like, it's not worth it, I'm just going to keep holding them. You can always use those shorter term put positions to make some money back and use that as a hedge against that longer position that you're not closing out of. So no bias. That's going to keep you from getting whipsawed back and forth when you think it should go up and it doesn't, or when you think it should drop and it doesn't. Don't have a bias. Read into those charts. Let them show you what's going on. Tyler, you're up. Your floor. What's up, Tyler?
Can you hear me?
Yes, perfectly.
Cool. How you doing, man? Appreciate you hosting this again. I just wanted to say kind of what you were saying, just don't have a bias, take day for day what it is, look at your charts, remember that, like you said, it can be up 600 points in a second, down 1,000 in the next. So lock in those gains. I'm more of a scalper myself. I think in any time, where we've ever been needed to be scalpers was now. It's tough to really swing things and, just be careful with that. Don't think hey, it's down 1,000 points today. Tomorrow we got to have a rebound because we've been seeing down 1,000, or we haven't seen a consistent day yet. So I think with me personally, I've taken a lot less trades on, and also I've been doing more common shares with the swings we've been having, how high IV is on options. For me, I've been having better luck just doing common stock. It's a little easier to manage, and where I see things on the chart, it's, for me personally, it's been a little bit better with the swings we've been having, and I've just been locking the gains in a little sooner. If I'm up nicely on something, even if I think it's going to continue running, in a split second, I'm in that Apple contract. The next thing I know, it's down $2 on the share, when I was just up $3 on the share. I mean, it's all over the place. So I think, like you said, to keep a calm head, just lessen your load, maybe do 3-4 trades in a day, and maybe 5 or 6 contracts versus 10 or 12, or 1 or 2 versus 5, stuff like that. That's been helping me personally. That's all I wanted to say.
Yeah, perfect point. If you're getting whipsawed and you can't stay in a position and make money, definitely size down. So if you would normally trade 10 contracts, yeah, trade 5 or 3. And if you normally trade 5, trade 1. And if you can grab a little bit of profit on those smaller trades, and you can do that consistently, then you're still going to survive, and you're going to build your account slowly. But building it slowly is better than taking, let's say, a $3,000 risk and you lose 50%. And instead you're taking maybe a $500 risk and you make a little bit of money if you make, but if you lose, you're only losing 50% of that, would be $250. So when the markets are just crazy like this, it's definitely a good idea to size down unless you're super confident in what you're doing. This is a scalper's dream right now. If you're consistently profitable, then obviously keep doing what you're doing. But for those that are struggling, definitely size down a little bit until you can grasp what's going on and the violent changes from highs to lows. I've sized down quite a bit on a lot of my stuff. And the majority of what I'm trading now is actually shorter term holds than what I'm even used to doing. So I like that idea. Definitely size down. And for me, it's been just shorter, in and out, quick gains, grab them and run, look for the next setup, instead of buy something now and 4 hours later, I'm still holding it, deciding where the exit is. I'm much more short term right now.
Yeah, definitely. All right. And once again, I appreciate you doing this. So I'm going to go on mute, and I look forward to hearing everyone else's ideas.
You're welcome. I think it's kind of a fun way to get a bunch of retail traders together and just share ideas. I mean, we all have Discord and Twitter and whatever, but if we can get together a few times and just share ideas, because this is more, the platform here just allows all of us to jump on and talk to each other instead of typing something and then someone responds. This is just, I think, more of an open forum where we can all talk to each other, instead of, it seems like we're not reading something, we're not being lectured to, you're allowed to talk back, and it's just a sharing of ideas. I kind of like the format of it. So
yeah, definitely.
We'll see how it goes.
Yeah, definitely.
So there's a question in the chat room. What if you're in a company 401k and 5 years away from retirement? So is there anyone on this call that does longer term investing? Anyone that does longer term investing, you've got the floor. Jump in and help us out here. I don't do a lot of long-term stuff right now. So who here does longer term investing that can jump in and give some suggestions or guidelines as far as just what they're doing specifically for maybe a 5-year plan?
I wish I had some more advice, but I'm young. I'm still working on my long-term investments. Just Tyler again, I wouldn't know what to say. To be honest, it's a tough situation, what everyone's in right now. I know a lot of people in my family are feeling it, and a lot of people I know are feeling it in their 401ks. And I think it's best to stay calm. Personally, if I was in anyone's position, I would take a little risk off the table, but I don't know. I'm no financial advisor. I can only say what I've been telling people in my family since January. We were way high. You got to take some off the table at some point, but now it's, that advice doesn't do any good.
Yeah, I think part of it would come into play as far as, like, there's people thinking, well, I should have sold, last week or a week and a half ago, or even 3 or 4 days ago. there's a point, I guess, at which it gets to the point where like, well, I guess I should just keep holding, because at some point we're going to rebound. I think the consensus is that we're not going to rebound for a little bit because the economy is taking a massive hit right now. People aren't allowed to work. So even if we get some kind of a stimulus package, at least for the next 2, 3, 4 weeks, people are not allowed to go to work. So even if we get a stimulus package that covers your bills for a month, what happens after that? So there's people that are really hurting right now. And if this stimulus package goes through, it's going to be a temporary relief. But I mean, what we've seen in the market now is unprecedented for, I'm going to say, everyone on the globe. I mean, we're comparing it to the Great Depression and whatnot, but I mean, the economy is going to take a hit. So there are people that should have sold maybe a week ago or so. If you're still in it, at what point do you say, okay, enough is enough? And are we past that point where if you're still in something, I know there's a lot of people saying, well, how much lower are we going to go? For me, the question is, it's not even a question. It's I don't want to see how much lower we can go, because I mean, this is crazy what we've seen already.
Hey, Mike, I might have something to offer on the 401k conversation.
Jump in, go for it.
Awesome. Yeah. So
who is this, first of all? Introduce yourself.
No problem. Sorry about that. This is Ted. My username is Spy versus Spy. So you and I've talked a few times. So, you know, I have an employee-sponsored 401k, just like a lot of folks do. It's through Fidelity, which is actually kind of nice, because what they allow you to do, and some people may have already taken advantage of this, is they allow you to create what's called a brokerage link, to where, because a lot of times, here, let me back up, sorry. A lot of times with an employee-sponsored 401k, you are pinned to their investment choices. And most of them suck. I mean, a lot of them are targeted funds, which are just horrible. Yes, you can just track the S&P, which obviously is very horrible right now. You can go bonds, which honestly is not a horrible place to be, although the market is basically flushing everything. I mean, you've seen what TLT and you know, some of the treasury, like the 20-year treasury bond ETFs out there, those get flushed too, which is insane. I mean, granted, TLT is doing great right now, but you know, so even the bond market, gold, everything is being flushed right down the shitter. So it's kind of a scary thing. But going back to the brokerage link concept, what you can do is just go cash. Let it sit there until the dust completely settles. And if you want to, and you think the market is still going to go down, just grab an inverse ETF like SQQQ, or what's the S&P? It's SPX. It's not S. That's what it is. So do an inverse leveraged ETF and make money on the way down if you want to. So there's a lot of different things. If you have control over your 401k from your employer, there's a lot of options that you can still do. If you know what you're doing, go ahead and grab one of those. You can still invest in all kinds of different things. You cannot do options in a 401k. Typically, you can't. Roth IRAs, you can. Obviously, regular brokerage accounts, you can. Brokerage link account, you cannot. It's just not eligible. So you're just stuck with equity, which isn't a bad thing. There's a lot of good stuff that you can do out there if you're really paying attention. JNUG, some of these things, they'll go off 80% in one day. So, there are some things there, but honestly, right now, cash is probably the best place to be. Just like Mike, just like a lot of the day traders out there, they don't care what the market's doing because they're sitting cash. So there's my spiel on it.
Yeah, and in the main chat room, Junkie makes a great point, is that we don't know how long it's going to take to recover. We don't know how much further we're going to drop, but statistically, 5 years from now, we should be higher than where we are now. And yes, that's just, look at the charts through every major drop we've ever had. That's why there's a lot of people that if you're long-term investing, dollar cost averaging is basically you're buying stuff at different price points throughout the entire time frame, whether it's up or down, doesn't matter. So if you look at the charts, we've never really had a period where for 5 years we've been down. So it's a matter of how much hurt are you going to go through between now and then. And certainly if you're closer to retirement, it's going to hurt a lot more. But if you have a 5 or 10 year horizon, if that's not money you were planning on taking out in the next 5 years, the idea would be 5 years from now, we're going to be higher. If we're not higher 5 years from now, that means all hell broke loose and Armageddon came by. Because charts, no matter how many times they've gone down or how deep they've gone down, they always end up going up. And that's just the way it has always been. Even through all these massive drops, the Great Depression, the finance bubble, everything. So, or the dot-com bubble, the finance, everything that we've had a major drop for, we've recovered and then gone higher. So if you have the time frame, again, I'm not going to give advice on when to sell or what to hold, but if you're looking at a 5-year time frame, it's one of those things where 5 years from now, we expect to be higher than where we are now. And like I said, if we're not higher than where we are now 5 years from now, there's probably more to worry about than I had money in a 401k and now I don't. At that point, it's just going to be survival and we're all going to be hunting for, buffalo to survive. So it's a matter of how much hurt are we going to go through between now and then. Is there anyone else who has a 401k ideas as far as what they're doing, whether they sold, whether they're holding? It looks like a lot of us are more geared towards the shorter term trading right now, at least as our method of trading, or just as something we're cognizant of right now, that's just what we need to be doing at the moment. But yeah, a lot of people have those longer term accounts. Even if you're a day trader or scalper, you probably have something longer term just parked there. So I feel bad for everyone because I mean, we're going through some financial hurt and we don't know if this is going to be over in 2 weeks, 2 months, 2 years. We just don't know what's going on. We've never seen any kind of conditions like this before. So is there anyone out there who just started trading? Either type in chat or jump on voice, raise your hand and I'll give you the floor. Is there anyone that's brand new to trading that's within the last month or so they just started? Okay, there's a few comments there. There's a few people. So here's the deal. If you guys are learning to trade in this environment, this is not by any means normal conditions. So if you can learn to trade in this environment, when things start smoothing out, you're going to be the best traders on the planet because you're able to respond quickly. You're able to make money when we're going up 1,000 and then down 600 and then back up to 1,000 all within the same day. So like these are just crazy times. So if you're learning how to trade now, the first and foremost thing you're learning is risk management. So if you can learn risk management, you're going to be an amazing trader when you don't have to stress it out over risk every candle that comes on a 1 minute chart. So it's definitely, it's really tough to learn how to trade right now. But for those that are just getting into it, like I said, if you're learning risk management in this environment, when it smooths out a little bit, you're going to be light years ahead of someone that just, so when I started trading, I could basically buy any ticker I wanted, sell it at the end of the day, and I was making money. And then the next day I would just buy whatever I was looking at and sell it at the end of the day and make money. I thought I was awesome. I thought I was going to be a millionaire in 6 weeks. Come to find out, the market was just going up. So it was hard to buy something and lose money on it. So when you start seeing volatility after you learn like that, it took me a little bit of time to really change my strategy and become more fluid with everything, because you can't buy at the morning and sell at the evening for the way I like to trade. Some people can and it's working for them, but for me, I'm now in tune with much more short-term trading. That doesn't mean it's right. It doesn't mean it's the environment you need to do that to survive. It's just what works for me. And that's just based on my personality and trade style. And that changed way back, not this February, but when we first had that February correction, that's when I really started changing from just buying something and sitting on it to more in and out shorter term positions. There's a comment there. I can't imagine being someone only trading stocks in this market. Yeah, that's the other thing. If you want to be a really solid trader, you kind of have to know how to trade multiple instruments in multiple markets. I am kind of limited in that I don't trade Forex, I don't trade crypto, I just focus on options. So for me, it doesn't hurt me as much because I can play up or downside with the same kind of risk with options. But if you only trade stocks and you don't short anything, it's going to be a really tough market for you to be successful with. Bobby Harris, you got the floor. What's up, Bobby?
Hey, you hear me?
Yep.
Yeah, so I made my first trade Friday. I funded my account with $300, and I made my first trade. I made 16 bucks, and I was ecstatic. And the whole time, I thought I was going to puke. And then after that, I followed a trade idea, and I lost 50 bucks. And I tried to trade out of it, and I lost another 100. So then I just cut my losses, and I'm going to try to learn more before I make another trade next week.
Yeah, so if you're brand new, like I said, it's really a tough time to learn principles of trading, or you can learn principles of trading, but applying them and actually starting to trade, it really is going to be a little bit harder because, especially if you're trading options. Now, if you said you made your first trade, are you doing options or stocks?
Yeah, I just did a small trade in options. I did one contract, and then when I got ecstatic on that one, and I followed that alert, and then I bumped it up to 3 contracts. And then that's where I messed up because I knew it was going to fall, but I thought it was going to bounce, and I let it fall further, and then I just cut my loss.
Okay, yeah. So first thing, when you're brand new to trading, I always recommend one contract only. And the reason for that isn't about money. When you're first learning to trade, it's not about making money. It's about learning entries and exits. And if you have entries and exits, the money is going to be there. It just will be. So when the markets are as crazy as they are right now, for a lot of people, we should be sizing down unless we're solidly consistent with the way we trade. For new traders, when the market is just as crazy as it is, if you're brand new, you're trying to learn how to trade, but you're trying to also focus on what the hell the market is doing, which right now is just, it can whipsaw. So for newer traders in a crazy market, I definitely recommend only a single contract because again, what you're trying to learn is how do I exit and how do I enter and how do I manage? And when you have, let's say you have a $300 account and you put 250 into a single trade, you're not focused on how to enter and exit. You're focused on each tick represents, oh my God, that was 10 bucks. Oh my God, I'm down 50. Oh my God, I'm down 80 bucks. You're watching the money. And the money is what's the hardest part to manage because you're focused on money. It's a mental thing for us. So you'll hear a lot of us say, we don't trade the P&L. Take it off your chart. You're looking at support and resistance. You're looking at the chart. It's not about the money. So when you're a new trader and you're seeing and focusing on the money, it kind of distorts how you should be looking at the chart. And in the market that we're in, you can be up 100 bucks 1 second and down 100 bucks the next. So it just kind of depends on, do we have a trending day or is this one of those whipsaw days? But options are going to be a little bit harder because the volatility is so high. So they're going to be more expensive. One of my favorite tickers is Twitter. You can get Twitter contracts for 30, 40, 50 bucks each. Right now, they're about $1 to $1.20. So they're more than twice the price they usually are. On top of that, the spreads are going to be a little bit wider. So again, just because of the craziness of the market, the spreads are going to be wider and they're going to be more expensive. So that's also adding to a new trader's worries that you might not necessarily want to use a market order because you're going to get screwed in the slippage and where you fill. And they're going to be more expensive than what they normally are. So if you're buying something longer term, the IV that's in those contracts right now, longer term is at some point going to pull out. So that's going to erode the contracts, just the price there. So again, I favor short-term stuff more so right now, especially for options, because the IV is just so juiced on these contracts. So you're paying more, there's a wider spread, and I'm trading liquid stuff, so I'm not really worried about getting in and out of these trades, but the spread is wider. So I might lose a little bit more than I would on a fill before this craziness came out. So before, when a spread was $1 by $1.10, right now it might be $1 by $1.30. So if I'm using a market order, I'm going to lose out on some of that slippage between $1.10 and $1.30. So you've got to be more stringent with where you're entering and exiting and at what price you're getting filled. So it's just a really tough time to learn. But if you can master this market here, again, you're learning risk management. That's the number one thing you need to do as a trader. So there are definitely skills you can pull out of this. But for your new traders, please, please, please don't go in heavy, because you're learning to trade in a market that can turn on you on a dime. Junkie, you're up. What's up, Junkie?
Hey, you guys hear me?
Yep, your
Okay,
floor.
cool. I wanted to add to what he said and just say, like, and I'm reading a book called Mastering the Trade right now by John Carter. He's the guy who popularized the TTM squeeze indicator, and a quote in the book that's not by him, it's just an old Wall Street quote, is bulls can win, bears can win, but pigs get slaughtered. And when you're new, it's really easy to get caught up in everything that's going on, and you want to size up and you don't want to miss something. Everything's moving fast. You have stuff getting called out in the room. You start seeing these patterns that don't exist. Like maybe it's a really sloppy head and shoulders, or it just broke through a moving average, and you have to get in. You have to get in now. So you get in on this trade that you don't really have a conviction in, because everything's moving so fast and it's so volatile. Now you're in a trade and it's going against you, and you don't want to accept the $50 loss. Now you're down 100, and you're like, okay, it'll pull back. I'll get back out at 50. Then you're getting squeezed and it's running, and you have to get out with this huge loss. And I think more than anything, just be patient when you're trading, especially when you're new, and look for those setups that you're learning, because more than likely you're going to be sitting there and you're not really going to know what's going on for most of the time. Like, I've been at this for 2 years, and I mean, I noticed that most of the days that I make money is when I'm not sitting there, like being greedy and trying to get into trades and trying to make things up in my head. You have to look at things a little bit more open-minded. If you open up Tesla and you think the whole stock market's going down, and maybe you don't want to play upside on Tesla, but you should also be looking for setups and be looking for the price action to either side. And don't go into things too close-minded, and don't go into things too anxious to make money, because realistically it's more about getting better than it is about making money. Money is just some kind of, it's just how you're doing it. You're not going to be a millionaire in a few days trading, and especially if you're oversizing your accounts, you have to set your stops. And that's something else. When I started out last year, I really was like, oh, well, it's stupid that everyone has these stop losses. Why do people do that to themselves? Like, it should be dynamic per each trade. And, that's partially right. But, obviously, if you're in a new account and you have a setup, you need to know where you're going to get out. You can't just enter a trade and go, oh, this trade's been going against me for 10 minutes. Now I've lost half my account. I have to get out. If you enter and you see a head and shoulders pattern, then you need to get out when the head and shoulders pattern doesn't play out. Or for some reason, if you break when there's volume breaking over view up and UVXY is dumping, and you see the momentum and you like it, and then all of a sudden a big candle comes in and it goes back under, maybe that's the time to close it. You don't want to wait 3 candles until you're really far down. So let your runners run and cut things when you have to cut them, and try not to get into trades right now where you're FOMOing, because everything moves so fast, and by the time you close an options trade out, you could be out a lot of money.
Yes, definitely. I see a few questions or comments in the chat room that says, one is, my biggest lesson that I'm learning is to cut losers. So that one's from Conrad. Yeah. So someone asked me a few times today, a few different people actually, on that specific topic, is how do you cut your losers? And there's a video I put on my YouTube channel about managing losses. And the example I put in there, I think it was a while back, I don't remember, but I think I lost like 10 bucks or 12 bucks. And it was like, well, it was only down 12 bucks. Why'd you cut it? 12 bucks isn't going to kill you. Why didn't you just sit in it? And the reason was it was a call and it broke support. So I cut it for a $12 loss. And then I show you the chart at the end of the day. Had I not cut it for a $12 loss, it would have been whatever, $60, $70, $80. And that was just, I think in the example, I think I just did a single contract on that. So a single $12 loss, I don't care about that. If it was an $80 loss and maybe the contract was 140 bucks to begin with, now I'm pissed. So if that trade was cut and then it turned around and went in my direction, I can always buy it back again. But if I'm now down 80 instead of 12, I can't get that difference back. That money's gone. The only way to get it back is to change the trade or for that stock to turn around and go in the right direction again. But if I'm wrong for getting out, I just get back in. If I'm not wrong for getting out, like there's risk reward and there's so much damage if you don't cut it when you should, that in the long run, I just don't think you're going to be a profitable trader. It's the reverse of what you should do. You're letting your losers run. So on a trade where I lost 12 bucks and someone's like, it was only 12 bucks, why didn't you just hold on to it a little longer? The reason was it broke support. If it turned around like 5 minutes later and went up, then I can just buy that same contract again or a different contract and reposition. But if I don't cut it and it doesn't turn around, it's going to hurt my account. And the only way to learn that is journal your trades. What I was doing was writing down where I said to myself, I should get out here, and then where I actually got out. And then at the end of the month, I'd go back to the journal and add up all the dollar amounts when I should have got out versus where I did. And it was a staggering difference between, oh, wow, every time I say this is where I should get out, but I don't, I'm losing a lot of money. And it dawned on me when I saw it on paper in front of me that I was doing it over and over and over until I said, okay, that's a dumb idea to keep doing. I need to change that behavior. There's a question in here. It was sent to me directly, not to the main chat room, so you guys can't see it. But is there anyone that uses TradingView? I use TradingView as like my backup chart. I don't really use it to during the market hours. Is there anyone here who uses TradingView? And the question is, what plan level would you recommend? Is there anyone that can jump in there that uses TradingView and can give a recommendation on what plan level?
Can you hear me?
Yes, who's this? Diana.
Yeah, so
You're up. What's up?
So I'm using TradingView and I have the Pro. It just depends on how many indicators you want on your chart, because the basic has caps you, I think, at 6 indicators. So all the moving averages, the 8, the 21, the 34, the 55, the 89. And if you like any TTM squeeze or any volume, you won't be able to have those indicators unless you have the Pro, the TradingView Pro.
Okay, so the main reason for the different levels would be how much information you want on your charts.
Yes.
Okay, so figure out how many indicators you like and take it from there.
Yeah.
I'm personally a fan of not really using indicators. People look at my charts and there's like typically one line on it and they're like, so like what indicators do you use? And I'm like, no, that's the chart. There's one line on it. That's all I like. Too many indicators and you're going to have 3 that say buy, 3 that say sell, and 4 that say don't do anything. So you're never going to make a move. So for me, I just don't like indicators for the most part. And when people are new and they're trying to find the holy grail of indicators, first things first, there isn't an indicator that's going to give you a buy here, sell here, and you're going to be a millionaire. If there was, everyone would know it and everyone would use it and everyone would be millionaires. So you're not going to find a magic indicator. They don't exist. So find 1 or 2 that you like. Find 1 or 2 that kind of gives you the information you're looking for and the tickers respect that. And when we're in a super choppy market like we are, use those kind of to support the idea that's in your head as far as, okay, I think this is where I should exit. And then the indicators are kind of supporting that idea, but you're not really using them to determine this is where I get in and this is where I get out. There's a question on there. What do you use? For me personally, I just use the 34 exponential moving average. And I have multiple setups. So I do have charts with different information on them. The only one that's on every single chart setup that I use is the 34 EMA. Tyler, you're up. What's up, Tyler?
I was going to bounce off of what you said before. I think it's very important to stick with your rules. You know, like you said, you got stopped out of something, you got stopped out. Regardless if maybe you got stopped out and then it ran on you, you managed your money properly. And I think that's what's very important is consistency, like anything in life, whether it's the way you eat, the way you work out, how you do your work at home, your love life, consistency. So you can get stopped out of a trade that ends up being a winning one. But what makes you a winner is that you do proper entry and exit and you execute yourself properly, like managing your money. You know, I think it's very important that people realize that, you know, like you said, it's not about the P&L. It's not about how much money you're up or down on it. It's really about what you're seeing on that chart. Money's going to come afterward. If you continue to make proper trades with proper entries and exits, you're always going to make money, whether it's $5 or $500. And you're going to lose money, but it's going to be very small versus very big. And I think someone who really points stuff out like that is something that you actually brought to my attention, Mike, is the Mark Douglas video. And I think that's a very important video that people should watch, is the one on YouTube. And, you know, it's very important, you know, the things he talks about in there, and saying that it's about wanting to take the next 70 trades, knowing that if you do those next 70 trades properly, you will lose a little bit, but you're going to make a lot more. And I think, you know, that's something to take to heart. Personally, you know, at least for me and myself in my trading career, and constantly learning every day, and, you know, writing, like you said, writing down in the journal. I write down almost every single one of my trades, what I was thinking, why I got in it, why I got out, whether it was green or red. And I track my weekly gains, my monthly gains, and I look back and see what I can do differently. And I just think, you know, I wanted to reiterate on that, because that stuff's important. You know, as someone as myself who's been through the ups and downs, you know, I've blown up an account before. It's not uncommon. And, you know, what really made me start having more consistent gains was being consistent with how I went about everything. So I just, you know, I think that's important, and I'm glad we're talking about it.
So to go back to the journaling thing, when we have these crazy swings in the market, you're going to see a setup and you're going to take it, and it's going to work or it's not going to work. That's how trading is, right? But in the crazy market, there's a lot of setups that might work, but for a shorter duration. So maybe we get a breakout, but it's not sustained. So going back to the journaling thing, if you guys keep track of what you're doing, and not just I entered here, but why? I entered here, but this is what I was looking at. This is what I was feeling at the time. This was doing that. That was doing this. So I entered the trade. And then while you're in the trade, take notes. Okay, we're approaching VWAP, but not a lot of momentum behind it. Okay, I see a big heavy volume sell candle coming in. So take all of these notes. And then at the end of the day or at the end of the week, go back and find which trades that you were doing that worked out. What's consistent about those? Out of all the trades that didn't work out, what's consistent about those? And if you do that, even with the crazy swings up and down, you're going to start seeing some consistency between the ones that work and the ones that don't work. And without increasing the ones that are doing great, if all you do is eliminate the ones that are doing bad, your account is going to do amazing things, because the ones you're doing great on, just leave them and keep doing it. And on top of that, eliminate the ones that are taking money away from your account. And you're going to build the account a lot quicker that way, just by eliminating the bad habits. So again, especially when we're having these crazy swings, journal all of your trades, and you're going to start to see the consistency in all my winning trades means this. Every time I lose, there's a consistency by doing this. And then all you have to do is start eliminating those things that are causing you to take those bad trades. There's a question there, are setups condensed now? Oh, hold on, let me read that more carefully. Are setups condensed now, as in something you would usually take longer can happen in a few minutes rather than a half hour? So not necessarily that. The setups might be taking a little bit longer to play out. They might be going a little bit shorter. What I've been seeing for some of the trades that I've been taking that have been consistently working and now are kind of hit and miss is some of them, and it depends on the day too. It's not in general, these were working and now they're not. It does depend on the day. But there's a few days where I've taken some trades that I would have 100% confidence in, and it would go up for maybe 4, 5, 6 candles, and I trade 1 minute chart. So 5, 6, 7 minutes, 10 minutes, and then it reverses sharply. Whereas the same pattern a month or 2 months ago, once it broke out of the pattern, we would just get continuation for, you know, an hour, 2 hours, or the whole day. So we're seeing some whipsaw where if there's a wedge formed or a descending triangle, we'll get the break, and then it's just not sustained. There's no momentum carrying it in that direction. Now, that's not every trade. There's some, I've got some descending triangles I took last week that just broke the pattern, and they just, for half of the day, just kept going in the right direction. So it's more so in this market that's just has the crazy ups and downs than previously, but it's not going to be every trade. Is anyone else noticing that with whatever criteria they use to enter their setups, they're just not seeing the continuation on, or is that just me picking some bad trades? Because I know there's a lot of trades I'm taking that are just playing out exactly as they should. But I know there's more so now in the last 2 weeks than prior to that, where the same setup isn't working the way it was. Junkie, your hand is up. You got the floor. What's up, Junkie?
Yeah, I definitely agree with you. I think that if you are using stop losses, or even if you just have it in your mind, or you're using a platform like TOS and TradingView where you're marking down where your stops are going to be or moving them perhaps, you might want to give yourself a little bit more room. That's not to say that you should just let your loser run and run and run, but you're going to see these setups where the price is going overview up, underview up, overview up, underview up, and depending on whatever reason you got into a trade, you have to remember that if it's a pattern, you're way more you have a very defined risk. If your pattern breaks, then you're out of the trade really. But I completely agree with you. Like, I am a more indicator-based trader. I use TTM squeeze, different kind of strategies that I've developed, and I've realized that if I give myself a little bit more room for my trade to work out, it genuinely will. But you don't want to be in a trade where you're sitting there also hoping, because as you said earlier, I mean, hoping doesn't do anything for you, and you don't want to let your losers run. With that being said, though, I just want to highlight the importance of, there's a lot of money that can be made in a few candles in this market. You don't have to sit there and, watch one of your winning trades get engulfed by one huge 1-minute candle. And I would definitely be careful doing that towards the beginning or the end of the day.
There's a question that I missed that I definitely want to address. Bobby Harris. Any advice with new people with a small account concerning PDT? Yes. If you go to a cash account, you do not have PDT restrictions. And I'm going to do a YouTube video on this because this is the most common question. It really bugs me when people are like, oh, I'm stuck in a trade, I can't close it. First of all, you can. You'll get a restriction on your account, but if you're up $3,000 and you can't, quote unquote, can't close the trade, hit that sell button and you're going to close the trade. You will get restricted on using that account, but if you're up $3,000 and let's say that's a lot of money to you, and then the next day you're going to be down $2,000 because you didn't close the trade, which is better, having $3,000 and a restricted account or losing $2,000? So a cash account means you're not using margin. If you're not using margin, that means you're not restricted to the PDT rules. So if I have $5,000 in an account and in a single day, I do 5 $1,000 trades, I can still do that without a PDT restriction. Now, options settle the next day. So I can use that same $5,000 the next day, plus or minus any gains or losses. The exception to that is Robinhood. Robinhood has different rules where in order to trade options, you need a margin account. So if you're on Robinhood, you can't get around the PDT rule unless you have over 25 grand. For everyone else, call your broker and just say, I don't want margin, just put me on a cash account. And you can make as many trades in a day as you want up to your account balance. And if you're trading options, they settle the next day. So the next day you can still use that same money. That is a big pet peeve of mine when people don't understand that they don't have to be stuck in PDT. Because I know a few people that would have amazing profits. This was back in the day when the market just went straight up. And they were buying these crazy biotechs that would go up 20, 30, 40% in a day. And they'd be up huge, but they quote unquote couldn't close it. And the next day they'd be down huge. And they're like, oh man, I should have closed it, but I was out of trades. And it bothered me just because they were making great money, but they couldn't lock it in because they thought they were paralyzed by PDT. There's a note from J124. Microsoft OneNote allows you to attach voice notes to your typed notes while journaling. So that would be awesome. You can basically speak your way through what you're doing. scrolling through the comments here. So if anyone has anything to say, jump on voice while I go through these comments and check out what I've been missing here. And if you're asking a question and not getting an answer, just type it again. For me, it's a little hard to kind of concentrate on what someone is actually talking about and then going back to the voices or to the chat room. So if we missed your questions, hopefully someone else is answering. If no one has answered, just jump in there and type that one more time. There's a question there. If I use the MA option on E-Trade, it's a little bit different because the exponential moving average is going to put a little more emphasis on the most recent days versus the further out days. So a regular moving average is going to take the average of whatever time frame, let's say a 10-day moving average. It's going to take the average of those 10 days, and that's your average. The exponential moving average is still going to take the average of those 10 days, but it's going to put more weight on the last day and then 2 days versus the 9th and the 10th day. So it should look a little bit differently. The one we're pretty much all using is the 34 exponential moving average. And it is on E-Trade. I use E-Trade and TOS, and I know the EMA is on both of those. If you're on TOS, if you type in EXPO, it'll pop up, or just type in the full word exponential. So if you don't see it on E-Trade, it's there. You just have to figure out how. I don't have E-Trade pulled up. I've been trading on TOS lately. So I don't know how they have it worded, but it is on there. I don't know how they have it listed, but it is on there for the exponential moving average. Tony, are you trading stock or options? And are you in Robinhood or not? For those of you trading options, options will settle the next day. So let's say I take $1,000 and put it into an options trade and I make $500 profit and I close that trade. Tomorrow, that 1,500 I can use to make more trades. So the T+2 is for common shares. If I trade $1,000 for common shares today and make $500 profit, I can't use that 1,500 tomorrow. That takes another day to settle, but options will settle the next day.
Yeah, where is it? Yeah, I'm trading options. Thanks, Mike.
Okay, so yeah, that's why we like options for small accounts. If you're brand new, a lot of people think options are a lot riskier, and they are in a sense, but they're not in a sense because they're defined risk. So if I buy something for $100, the most I can lose is that $100. And we typically don't let options go from whatever we purchase to zero. So you're not going to lose 100% of it. But worst case scenario, you can only lose what you put in. So if I put in a $350 options trade, the most I can lose is that $350. Now, if I make money on it, I have that $350 available to use tomorrow. If it's $350 in common shares, I can't trade that tomorrow. So you want to be in a cash account with options because you don't have to worry about PDT and they will settle the next day. Junkie, what's up?
So I want to stress something that I went through when I switched from a cash or from margin to cash. Some people may like unknowingly be, it may be a good thing that you have PDT on you. Because you don't realize that, if you're sitting there and you're like, wow, now I can trade whenever I want. Now I can use my full $1,000 every day, let's say. You'll start trading more often, and trading more often sometimes isn't as good as it would be to just have the PDT on itself. I'm not telling anyone to stay on Robinhood or any of those kind of platforms because I think that's really how you lose money, but just be careful having the ability to trade freely as you would like, because you might not realize the type of effects it has in your mental.
Good point. Any kind of restrictions on your trading do exactly that. They restrict you. So sometimes that might be a way to really focus in on better setups instead of just kind of, this one looks good, I'll take it. And if it doesn't work out, that one looks good, I'll take it. So sometimes restrictions might be better in the sense that they do force you to really focus in on the setups instead of just taking what you think is a setup maybe you dig in a little bit more knowing you only have 2 or 3 trades that you're allowed to make. So that's a good point. I still prefer personally to be non-restricted, but I can see how, and that did it for me when I went to a smaller account. And I was telling people, typically I start the month in a smaller account because it forces me to focus on the trade. And with a limited amount of buying power, is this the trade I want to take? And sometimes in a bigger account, I'll take a trade that might have a little more risk to it, because if I lose money on that trade, I can still keep trading. But when I go down to a smaller account, if I lose money on that, it's going to hurt the account. And then it's going to hurt your ability to buy multiple contracts. And then it's going to hurt your ability to grow that account. So I can see how restrictions would be good, because it really forces you to think about the trade a little bit more. And is this the trade, if I only have 2 or 3 trades to make, is this the one that I'm willing to put my money into? Or maybe should I wait for a tighter setup? So yeah, I can see how there's a benefit to restrictions. But what I don't like is when you're in the actual trade and then you think you can't close it and you're stuck in it and end up losing money because of that. That I absolutely hate.
So horrible. I've heard people before who have started out option swing trading, like you see on like the Wall Street bets and those kind of crazy people who basically are gambling. And then they realize they can't close their trade out, and now they're losing a ton of money. Honestly, in this environment, I would not even swing trade, but you know, if that's your thing, that's your thing.
A lot of the money right now seems to be made after hours. So when you're buying stuff at the end of the day, swinging into the next day, there's a lot of money to be made. But if you're in the wrong direction, you're going to lose all of it. So again, it's a risk factor. And how confident are you that we're going to continue to go in that direction? I think it was in the last 2 weeks, we didn't have that back-to-back green day. So if you had a green day and then tried to swing into the next day, every time you would have lost that. So it comes down to risk tolerance and the types of trades that you're trying to take. I'm not against swinging by any means. It's just not for me right now in this market environment. So for me, it's just a matter of I'm not comfortable holding stuff overnight. I can grab my profits or losses, cut those, and then by the end of the day, I sleep well at night. Whether futures limit down as soon as they open, like today, I think it was 3 or 4 minutes, we hit that limit down mark for futures. I don't care, it doesn't affect me. I'm not trading futures and what happens tomorrow. It just doesn't affect me. I don't have any open positions. Tomorrow, whether we're up or down, I'm going to take advantage of that. But like we have these crazy $400, $500, $600 or 600 point swings. And for me personally, it just doesn't matter whether it's up or down because I'm not holding things overnight. But again, a lot of these moves that are happening after hours, this is where a ton of money is to be made. You just can't be in the wrong direction, or as quickly as you make it, you just lose it the next day. So it just comes down to a comfort thing. For those that are more experienced with swing trading and more comfortable with it, they're making great money. For me personally, it just stresses me out to be in a position that I know I can't control. And then whether the market opens up or down, all I can do is react. Once you hit the buy button and the market is closed, you can't control anything about that trade until the next bell that opens the market again. And for me personally, I just don't like that feeling. So it's like an anxiety thing where I'm just comfortable knowing whenever the market opens, I can trade again. And whatever happens between now and then just doesn't matter because I'm not in a trade that it's going to affect. But I'm not going to downplay anyone that wants to swing. It's just not my style. And Junkie, while you were talking, I want to point out, I saw you post the link to this in the Discord group. So thank you for that.
Oh man, I wanted to mention one more thing. So the difference between swing trading in this market and just regularly is, let's say you're swing trading Tesla, for example, or maybe Tesla's actually a bad example because it's gone against the grain some of these days here. But I mean, swing trading most stuff right now, like any single one of your setups can get completely messed up by the direction of the overall market. So, you know, normally maybe like a few months ago, you could swing trade on a good setup and that setup would work for you. But now you're going to get a good setup and then the whole market moves down and went limit down like tonight. And I mean, most of the supposed good setups might not work. I mean, there's certain stuff that does well in the market overall, but I mean, you can just get completely messed up right now. So unless you think that you can like guess the overall direction of the market, most of the setups might fail.
I mean, I agree with what you're saying. I typically don't swing trade myself, but I think in this market, what do you think about is it straggles or strangles? I'm not even sure what it's called. But when you buy sort of both directions, and because I mean, like what we've seen recently is how big what kind of big moves happen overnight, right? And that way, that the next day, even if like if one of them is up, you're able to take profit, and you're almost guaranteed that it's gonna go reverse eventually within the next day or two. I mean, we've been going this sort of, it's all downward, but there's a zigzag sort of pattern happening. So, I mean, what do you think of going, if you decide to swing trade, right, going both directions and sort of taking advantage of the big swings that we're getting?
If I were to swing trade right now, I would definitely be selling and not buying.
Okay.
Is there anyone here that does those complex strategies? Because I am 100% directional. I've never traded any kind of a spread or anything like that. So I can see where they're useful, and there's definitely a place for them here, but I don't trade them enough to really give advice on whether they're working or how they're doing on a swing. Is there anyone in here that trades spreads or other complex strategies? If so, the floor is all yours. If not, we'll have to get you over in touch with one of our Discord members that trades those quite a bit. There's a few people over there. They're not really posted too much in the main rooms because they are more complex, but there's a few people that will trade those strategies.
Okay, cool. Thank you.
You're welcome. And there's a question in there that's kind of important. What is your typical stop loss? So here's how I handle stop losses. One, I don't set hard stops because I'm in front of the computer all day long. So if you're not in front of the computer, please have your levels set up and know where your stop is and place a hard stop on there. I am in front of the computer all day, so I don't need to place the hard stop, but I still have levels of stops where I know this is where I'm going to cut the trade. Here's my speech on those though, is I don't like a certain percentage or dollar amount. I know some people do, but for me, and there's various numbers. So the people that use percentages, some will say between 20 and 30%. And then there's some that say, if I lose 50%, I'm out. Even if it's going to turn around, if it hit 50% loss, I don't care what it does after that. That's a steep enough loss, I'm cutting it. And you can have that, I guess, as a basic backdrop. But since I'm in front of the computer all day, for me, it's not a percentage or a dollar amount, because when we say I'm going to take a 20% loss and then cut it, that 20% is an arbitrary number. That 20% means something to me based on the position size. It doesn't mean that the market is going to respect a 20% drop. So for me, it's more support and resistance. If I'm in a call and it breaks support, whether that's 2% or 20% or 28% or 40%, the percentage doesn't matter. It's when it breaks that support, I have to cut the trade. When I'm in a put, if it breaks above a resistance level, I have to cut that trade. So whether that's 2% or 40% doesn't matter. It's the fact that it broke through a resistance. The percentage that it's going to end up being is dependent on how good my entry was. So if I have a really good entry and I break support or resistance, I'm not going to lose that much. If I chased something and now I have to wait for it to retrace a good amount before it tests that support or resistance, that's going to be a painful loss. So it's more about the entries. And then going back to a certain dollar amount, like I don't want to lose $100. I don't want to lose 500. Again, those are arbitrary numbers. So imagine cutting a trade at 20%, and that's your stop loss. The most I'm going to lose is 20%. And then the stock is going down. Let's say you're in a call and it's going down towards that 20% level. It hits 20%, you get stopped out. But 48 cents below that for the underlying is a support line where it bounces. Right? How annoying would that be to get stopped at 20% knowing you only had to give it 40 cents more, 48 cents, 13 cents, whatever, to find a support line and bounce. So it's not necessarily the percentage where I'm looking to cut, it's whether it breaks a support or resistance. And because the support and resistance levels are where people are actually buying and selling. So it's not the percentage gain that the markets and the charts respond to, it's where the buyers and sellers. And that just comes with support and resistance, not an arbitrary number that I'm saying, I'm only comfortable losing $100. I'm only comfortable losing $1,000. I'm only comfortable losing 30%. Those are just numbers that I'm making up because they mean something to me, but the market doesn't respond to those numbers. So for me, it's all about support and resistance. But again, that's because I'm in front of the computer all day. I can watch and monitor what's going on with these. If you have to put in a hard stop, what I will say is I used to track the alerts from Blackbox religiously, and I had spreadsheets on them and I would track the drawdown. A lot of the alerts will come out with an alert price and then drop between 20 and 30% before making maybe an 80% gain or a 200% gain. So if your stop is too tight, you're going to get stopped out of trades that then turn around. That's just part of trading. And if you sized wrong and you're down, let's say $500, and that's a lot of money for you, and it looks like it's going to keep going down, you've got to cut that. And then if it turns around and bounces, then you realize your entry was wrong because it dropped $500 worth before it turned around, or the $500 was too much for you, so your position size was too big because you couldn't afford to let it go down to a support to see if it was going to stop there. So it comes down to position size, it comes down to risk tolerance. If I had to give a percentage, I would prefer more like the 20 to 30% range than the 50% range. Because if I'm down 50%, I really screwed up that entry. And will it come back? It could, but the likelihood of it coming back from 50% versus 25 or 30%, it's just, when you're down 50%, that hurts. And that underlying can go back to where it was, and those option contracts might not be back to where they were. So 50 for me is a little bit too much. If I consistently take 50% losses, I've got to look at my entries and see why I'm screwing up the entry. So who else has stop loss info? How do you guys do it? Someone jump on and tell me your stop loss methods.
Something to add here. So if you're, let's say you're not using price action, like if you're getting in, as I said before, on like a head and shoulders, you can see whether the head and shoulders fails. Even if you're using like very heavy indicator based trading, just make sure that you're still making those support and resistance lines. Even if you're doing something as simple as going onto a 15 and a 5-minute chart and drawing horizontal lines onto the candlesticks, just try to have some idea of where support and resistance is going to break.
There you go. Another vote for support and resistance. Sean Skillman, you've got some good information in the chat room. Are you on voice? Do you want to jump on and talk to us? If not, no worries. Any other questions on stop losses? Anyone want to jump in and tell us their method for using stop losses?
Does this work? Can you hear me?
Yes, what's up?
All right, great. Best advice for stops, you have to realize you're still in a trade, so you have to manage your trade, and whatever you take for your position, you want to be able to determine what your risk management is in the trade. So just be conscious that if you're trying to make money in a market, you want to be adjusting your stops. And if you feel comfortable with a certain percentage, you probably want to have it back tested out. If you're a day trader, you just want to keep your eye on whatever the bid and the ask is, or try and nail the mark. A lot of times day traders try to get the peak of the move. So when you're glued to your screen, you want to be in a order to exit your trade with a limit. If you're at work, you can use a stop limit, trailing stop. That gives you a couple options where you have more buffer below you for protection. If you are looking to use stops at all, that's really the only choices you have. So back test what you feel comfortable with. If you're a day trader and you are actively trading, now you have to keep in mind the value of alpha is actually the value of active investing. So if you're looking for gains, you want to be very consistent with how you manage your capital. So that's just some advice for if you're placing stops, you want to be aware of it, and you want to be the person placing your own stops based on what you feel is comfortable for you. If you're doing trading from work, a lot of people, it seems like they'll use charts that go out a little bit further. Most times, some of the guys that we listen to a lot, they trade with like daily candles. So if you want, you could each day adjust the risk that you have on your position and move it and adjust it accordingly with the wicks of either the previous high of the previous candle, which would be a tighter stop, or you could use a midpoint in the previous candle, or you could use the low of the wick of the previous candle. So that kind of gives you an area where you could like back test support or have a bit of a pullback. You just have to be aware there's a lot of psychology that goes into it. But if you're actively trading, typically you're going from point A to point B, you're getting on the train, you're getting off the train, and you want to get your money at the end. But if you feel like you're needing to place stops, it's for your safety to place those because you won't be attending your trades. So just keep in mind that, you know, you have to own the responsibility of, okay, well, if I'm not going to watch my trades and I'm going to place stops, what should I be placing my stops at? What value am I looking to get out of it? How much do I think I'm able to make? Or where should I put stops so I don't get stopped off if it keeps running again? You want to just be very conscious that you're in control. So just manage your stops. It's just part of being a trader. You just have to manage your stops. That's how you get your money. And that's kind of my rant, I guess.
Thanks for sharing. We appreciate that. Yeah, so someone messaged me the other day and they're like, hey, I saw that you guys do this, but I work and I'm trying to place trades from work. And I used to do this when I was working in retail and trading at the same time. And if I had to do that now, honestly, it would probably freak me out. Like just, I'm a pretty calm person for the most part, but if I had to place a trade and walk away from the computer, I would pretty much guarantee that anxiety would kick in immediately. Like I just like to be in front of my charts when I'm in a trade. And if I had to walk away, I just don't know if I would be just success would not be there, I don't think. Because I don't know, I just don't think I could do that. And then I started off trading when I was working full time. So it's a little bit different for me now, having been in front of the charts the entire time, to now go back to place a trade and then put a stop loss and walk away from the computer. Like the stop loss would protect me on the downside, but I think it would just freak me out as far as trading overall, just to be in a trade, knowing I'm in the trade, but not glued to the charts while I'm in it. How many of you guys are traders while you work a full-time or even part-time job? Join that chat room there and just post in there if you guys are trading while working or placing trades with stops while you're out at work.
Can I hop on real quick?
Go for it, all yours.
I trade at work and while I'm at home on my days off. And, you know, I can't stress anything, but if you're going to be trading at work or anywhere where you're not in front of your computer, please use stops. As far as stops go, I personally, when I do shares, if I'm doing commons, you know, with my support and resistance, if I'm short, I like to be a little bit above where I think, you know, resistance is, just in case, you know, we get a little above resistance and then get snuffed back down. And the same with support. You know, if I think support's at 1158, I'll probably put a stop loss at like 1148, you know, 1150, give myself a little bit of room. But, you know, I work full time. I do have a couple of days off a week here and there. And so generally I am on the go, and I almost always have a stop loss in. And, you know, I just need to stress that because I've been caught with my pants on my ankles before where I thought I had a stop in and I didn't. And next thing you know, you're down 50% on the contract in like 10 minutes. So it's very important to have those stops. And if you're going to be trading, you know, from work or somewhere where you can't be sitting in front of a computer screen.
And while we're talking about stops, and while most of us I don't know if most of us actually, I'm assuming that because I know a bunch of you in this room are trading options. Stops and options. If you guys are on Tastyworks, I do not use Tastyworks anymore. So from what I hear, and this isn't firsthand, so I'm passing along information that I've learned from the group that I trade with, stops on Tasty do not really work so well. So just a bit of advice, if you're on Tasty and you set a stop loss and walk away, I don't know the confidence that I would have in that because I'm hearing from a lot of people, and Tasty kind of doesn't believe in stop losses. The way they trade and the way they teach trading, it's just a different format. So they don't really use stop losses so much. So it's a feature on there, but from what I hear, stop losses on Tastyworks do not work very well. So take that into consideration if you're on Tasty. The idea behind stops are the same anywhere you go, but from what I hear, they do not work quite as well on Tasty as far as getting executed.
I was gonna say one more thing. You know, I think that it's for putting a stop on an option can be difficult sometimes, especially when you're trying to like figure out, well, where you think that stop should be on an option versus like where you see support on a common. And for me, I think it comes with time, you know, and other people might have formulas and I'd love to get one if you do have one. But for me personally, it's kind of like where my risk is on that trade, like how much I'm willing to lose. And also more often I trade the same tickers for a reason. So I understand, you know, I feel as someone who's learned to trade, I can trade anything, but I prefer to trade particular tickers that I know how they react so that I know when, you know, if I enter a trade with an option, I kind of have an idea of how far I'm willing to let that option go down in reference to how I know that stock acts. And that kind of gives me a better gauge of where I put my stops, you know, for setting a stop for an option at least, because it's not always the easiest to know where an option will be versus where the common share price is, at least for me. You know, other people have formulas for stuff like that. I'm not the best at it. But it's really come with like learning the stocks that I'm trading and understanding how volatile those options can be one way or the other. And, you know, some of them can be, you know, very volatile, like your Teslas and your Amazons, and some can be, you know, a little less like Apple. And then like with, you know, Mike does Twitter. Twitter's a great one. You hop in it. You don't really got to worry about swinging crazy percents. You know, it's a great thing. It's a beautiful thing. So I just wanted to mention that as well.
Yeah, again, it comes down to personal preference on a lot of this stuff. So no one here is really preaching as far as this is how you have to trade. It's just kind of an open sharing of ideas. So we're all going to do things a little bit differently. The way I do things doesn't mean it's right. It just means it's right for me. And the way you do things doesn't mean it's right. It just means it's right for you.
Exactly.
So what I like about these discussions is I can hear something from another trader and say, oh, you know what? I like that, but I haven't done that. So let me try and incorporate that. So again, if you do something different from what you're hearing from me or what you're hearing from Tyler, it doesn't mean you're doing something wrong. It just means you found a way to make something work. So if it's different from what you're hearing, that's when we want to get everyone to jump in and share those opinions. Because again, when we have a bunch of people doing the same thing, but doing it a different way, by sharing those ideas, that's what can help hopefully make us all better traders in the long run, and opening our eyes to maybe a technique or strategy that we haven't even heard of or been exposed to, but might work for us as well.
Yeah, exactly. And once again, that's why I'm grateful you've done this, so we can all sit here and share ideas, because knowledge is power, and that's going to get us to be where we want to be.
It really is, because I get messages on Twitter and even from Discord that are people like, hey, so I did this and it didn't work out. What do you think? And I'm like, where did you get that idea from? And there's no way to know. Like, even if I post something on Twitter, you guys don't know me. You don't know if I'm putting out good advice or not. I'm just a random person putting out trade ideas on Twitter. So It's hard to figure out who to follow and who to trust and this person says a lot of stuff. Should I understand what they're doing or should I ignore what they're doing? So again, like, you guys don't know me other than you know me from either Discord or Twitter. So why trust anything I say? So anything that I say, again, it's my opinion and what I've learned. So I can share that with you guys, and then you just have to understand, do you agree or disagree? Have what I said, has it been truthful? Has it played out right? If not, don't listen to anything I say further. If it does, continue to listen. And find that for everyone that's in the group sharing. Find people that are sharing stuff And the way we figure out, do we agree or disagree with them, is listen to what they're saying and then follow some of the advice and see what works and see what doesn't. So again, I like the group like this just because I'm hoping to get ideas from you guys that I don't consider currently. And I hope some of the things that I say will open your eyes to something that I see that maybe you don't currently. And I see right now, Tony's got his hand up. So what's up, Tony? Jump in here.
Hey, so I've followed your recommendations on Twitter occasionally, a couple times, and they've worked. So I think it's a really good trade for small accounts. I was wondering if you use that same strategy on any other tickers, and if it's just something that you use for that one because you know it. I know there are certain, as someone who was speaking a minute ago said, I know certain markets, so I can tell what'll happen kind of just out of familiarity whenever something is going in a certain trend. Do you use that strategy for other tickers, or is it strictly for Twitter?
Are you referring to the orb opening range breakout?
I believe so, yes.
Okay, so the main chart that I look at, or the main screen that I look at during the day, has 9 tickers, the UVXY, and a blank chart. And the blank chart, I cycle through whatever I hear someone talk about, oh, something's going on with this. I can pull it up in the blank chart. Otherwise, the other screens don't change for me. So they're the same tickers every single day on my main chart. Every one of those has the orb, what is it called? The script. Every one of those charts on my main screen has the orb script on it. So I'm watching that on all of the tickers that I watch every single day. And typically the first trade of the day for me is that orb strategy. It's not just Twitter. I love Twitter because of the action on the options for Twitter. And on a normal day, Twitter can give you 20 or 30% all day long without the crazy volatility we've seen. With the crazy volatility, it's just giving 50, 60, 70% gains. So it's crazy. But I don't restrict it to Twitter. That's just, I'm screaming about Twitter all the time because I just love the way that ticker works. And for smaller accounts, it's perfect because you can get, right now they're, 70 or 80 bucks for a contract, but they used to be 30, 40, 50 bucks. So the main screen that I'm watching that has, it's got really 8 tickers that I'm watching. And then at the bottom, it has SPY and UVXY on it. So I'm kind of monitoring those. The 8 tickers at the top that I'm watching don't change every day. They're the same 8 every day. And the orb strategy or the script is on all 8 of those. So for me, I can watch those 8 and including SPY 9. Out of those 9, there might be 3 or 4 every single day that gives an amazing orb trade. Now, let's say I was able, and I don't do this because I can't focus on 9 at once. Let's say I took all 9 orb trades. Or let's say there's 9 on my screen. In a typical day, there might be 1 or 2 that don't present a trade based on that. They're just not breaking out of that range. So let's say there's 7 trades left, 7 tickers on my screen. Out of the 7, let's say 3 of them present an orb strategy, or I'm getting confused. Let me rephrase this. Out of the 7 trades left, they all present an orb trade. So there's 9 on my screen. 2 will stay within the range and don't present a trade. 7 present a trade. If I were to take all 7 of those and only 3 of them worked out, those 3 will far outpace the 4 that don't work. And the reason for that is just based on how I manage the strategy. So typically out of the 9 tickers that I'm watching, there's usually 2 or 3 that are going to be great trades out of it. And the question is, can you just spot and get into those trades? So there's times where I'll pick 2 of the trades and maybe they work out great, maybe they work out okay, but there's 2 other tickers that would have worked out amazing. And I just didn't take the trade on those 2 because I don't want 4 or 5 open positions at once. So I see the breakout for, let's say, 2 or 3 tickers, and I'm going to pick 1 or 2 of those to trade. I'm not always picking the one that goes up 400%. I wish I could do that every day. But out of the list that I have, there's 9 on my screen. On any given day, 2 of them maybe don't present a trade. The other 7 do. And out of the 7, maybe 2 or 3 work. And if you took all 7 trades, the 2 or 3 that work far outpace the ones that don't work. So in order for this to be almost, and I'll say nothing is guaranteed, but in order for this to be a highly successful, almost guaranteed, I would have to take every single trade on my chart or on my main screen. And then I would have much greater success with it. But I'm comfortable managing 1, 2, maybe 3 positions at a time. So I'm not going to do that thing where I'm taking all 9 trades and then cutting the ones that don't work and letting the others run. I'm kind of watching the price action to determine which one I'm really going to focus on. But the strategy is just support and resistance. So
what are you using for those support and resistance? Are you using pivot points? Is there something that we can look at as far as a certain study that would make sense to put on there for ours?
Well, if you're using orb, it's a specific strategy. It's a time frame. So for me, I use 15 minutes. What that does is after 15 minutes of the market, it plots the high and the low. And then all I'm looking for is a break above that high point or below the low point. So any ticker within 15 minutes, there's a high point and a low point for every ticker on the chart. It's just, if you use 15-minute candles, it's the high and low of that first candle. I use 1-minute candles. So after 15 candles print, the 16th candle, there's going to be a high and a low point that already printed. It's not necessarily that 16th candle, but within the first 15 minutes of the day, there's a high and a low period. So the lines get plotted at that 15-minute mark. Wherever the high and the low was within that 15 minutes, those lines get plotted. And then I'm looking for a break above or a break below. So you can do that on any ticker because every ticker is going to have a high and low within 15 minutes. So it's essentially just cutting out the volatility of the first 15 minutes of the market and then letting the market kind of find a direction. And then it's trading a breakout in that direction. So you can do that on any ticker. You can do that on anything that has an opening and a closing. As soon as the bell rings, you're plotting a certain time frame, and then you're taking a trade when it breaks above or below that range. So I do have a video on YouTube that goes over that. Look that one up. It'll describe what the orb strategy is and how to use it. But it's basically just support and resistance. And the time frame, some people use 5, some people use 15, some people use 30 minutes or an hour. I like 15 because it cuts the morning volatility out, but it still lets me capture some of the movements a little bit earlier than if I was waiting for 30 minutes. So that's one of those things you just kind of check it out, play with it, see what works for you. What works best for me is 15 minutes because I started doing 30 minutes, and 30 minutes, I'd see a big move, but I'd miss a good portion of the move because I'm waiting for 30 minutes of the market. So I found when I do 5 minutes, I get shaken out quite a bit. When I did 15 minutes, I really found the sweet spot for me that cut out the morning volatility, but still allowed me to get a good portion of a move versus 30 minutes, which would cut out a big portion of the move. So I just played around with the time frame to find what works for me. But I know people that use 5 minutes. I know people that use an hour. So it's just a matter of figuring out which one is comfortable for you, which one works for you, which one basically allows you to see what you want to see.
Appreciate it.
Anytime. Diana, you're up. What's up, Diana?
This is about support and resistance. One of the things that I do, and it works for me, is I look at different time periods. I look at the 15-minute chart, 30-minute chart, 1 hour, 2 hour, 4 hour, sometimes even daily. And I draw my support lines based on aggregate of price action. And then when the day opens, I usually zoom in on the 1-minute chart. And after about 15 minutes, I draw my trend lines as the day goes on. And my trend lines are always changing depending on the movement. And it helps me predict previous support, previous resistance, and the overall trend of the ticker.
Yeah, so a lot of people will do support and resistance on multiple time frames. So that's awesome that that's kind of how you're working it there. So on my charts, I'll have the time or the support and resistance for the daily going back for an entire year. So it's a daily chart that shows me a year of time frame. I'll plot the support and resistance there, and that's going to show me the major levels in the past year, but I'm trading in and out off the 1-minute chart. But a 1 year time frame is going to have stronger resistance than, let's say, the last 2 or 3 days. So if I know there's a support and resistance on the 1-minute chart, but there's another one, let's say there's a support line at $50 on the 1-minute chart, but the support line on the daily chart is, let's say, $49.20. I'm going to give it to the $49.20 instead of the $50 because on the daily chart, that $49.20 should be a stronger support. So I've got them on multiple time frames, but I'm still drawing them on the 1-minute and entering and exiting on the 1-minute. And that sounds like what you're doing there. So we have a similar style where we're trading on the short time frame, but we've got the longer term support and resistance also. And I think that's a smart way to do it because your longer time frames are going to be stronger support and resistance lines. So for me, it's helpful to have those on there. And then I do the same thing as you. I draw on the 1 minute chart throughout the day. I'm adding more lines to the chart. And it looks like Tyler does the same thing. So there's a few of us that run it that way. And it's really, if you think about it, you want multiple support and resistance timeframes on there, because if it breaks your support on a 1 minute chart and that's the lowest line that you have, where is it going to stop next? You want the next level down, which might not be on that 1 minute chart. You might have to go back a week or a month or whatever to find the next level. And you might have a weaker support on a 1 minute chart, but like I said, if a few pennies down or $1 down, there's a stronger support that was, you know, tested 4 or 5 times in the last year. I would think that would be a little stronger than the 1 minute chart. So depending on my risk tolerance, I might let it drop beyond my daily support to that support level that's been tested 4 times and held. So yeah, definitely helpful to have multiple timeframes. And if you guys are in Discord and saw Pete's charts, he has timeframes or support and resistance on so many timeframes. And what he's looking for is clusters. So on a daily chart, where is their support and resistance? And on a 15-minute chart, is there support and resistance levels that line up with the daily chart? And on the 1 minute chart, are there levels that line up with the 5-minute, 15-minute, and the daily chart? And when you have levels that line up on multiple time frames, those are the clusters that he's looking for. So he's looking for those really strong levels that it's support on a 1 minute, it's support on a daily, it's support on a monthly. And those are going to be stronger support levels because on multiple time frames, that same dollar amount, that same dollar level has been, you know, tested and held. Samosa, pretty much, yeah, he's got support and resistance going back to the 1990s. So some of his charts, like I look at, and it's hard on my eyes to see that, but because he draws them, he knows exactly what every line represents. And that's how you want to get with your charts. You want to get it down so that when you look at a chart, you know exactly what it's showing you. For me, if you've seen charts that I post, there's usually 3 lines maybe. And for me, that's just because if there's too much on there, I just get distracted. But for him, what works is having all of those lines on his chart. So he found a way to make it work for him. I found a way that makes it work for me. And he is a billion times of a better trader than I am. So if it's me versus him giving you conflicting advice, do what he does 100% of the time. But again, that just goes back to what works for you. For me, if there's too many lines on the chart, I just get distracted and it's harder to see what I'm looking for. But for him to have more lines on there, it works. And he's amazing at what he does. So I can't say he's wrong, and what I do works for me. So I can't say I'm wrong. It's just a different strategy. And we just have different things that work for us. So again, that's why when you're new to trading, it's hard to go out there and say, well, this person says I should do it like this, because everyone has a slightly different method of how we do what we do. So what works for me might not work for you. But if you've never heard of the way I do things, I can certainly open your eyes to how I do it. And then you just have to decide if it works or not. And then what works for you might not work for me. But if something you do is super successful for you, I want to know about it. And then I can apply that to my trading and say, oh, wow, I've never done this before, but it looks like it works. Or, you know what, he's super successful doing that, but it doesn't work for me. So I'm going to discard this information, but maybe hold on to this. So again, that's the benefit of a group like this. If we can get together periodically and just share ideas, I'm hoping to learn some stuff from you guys that I don't currently do or consider in my trading. And hopefully some of the stuff that I present to you guys, same thing. Hopefully that opens up your eyes to something maybe you don't do currently. Open floor. Who's got a question? Who's got a comment? Someone take over here and give us some. Sean, I see you just popped in there. What's up, Sean?
So this might help everybody. You know when you're making popcorn and you have to wait till it stops popping before you take it out, before it's done? So as volume's flowing into whatever the hell you're trading, just kind of view it like you're popping a bag of popcorn and you're trying to get it as full as possible. And then when it's done, you take it out of the oven, the microwave. So you kind of just have to keep your eye on everything, and whenever it starts losing the pop, whenever it starts losing the ability to make more popcorn, just take it out. Take what you get, and then enjoy the bag of popcorn. I guess that would just be my trading philosophy.
That is an awesome analogy.
for
Because when
this
you take the
Sunday.
popcorn bag out of the microwave, you know there's kernels in the bottom that haven't popped yet.
It's all right.
But if you try and get every kernel that's popped, you're going to take some that already popped and they're going to be burned. So there's a fine line between taking profits and trying to squeeze that last penny out of your trade.
Or like when you're camping and you got a really nice bonfire, you're trying to toast a marshmallow. You want to be careful that you don't burn it, but there's like a fine line there. So it's like, you know, when you have to take the marshmallow out because it'll be on fire if you don't.
Another perfect analogy. I love that.
Now this guy's speaking my language, food and trading.
Hey man, I'm a guy. Let's go.
I like it.
Yeah, when
Yeah,
you're
some
loading
of
your
us are-
cooler, you want to make sure you got like, you know, all the good stuff.
Yeah.
Some of us like our well done cheeseburgers, man. This analogy's gonna fall off.
Oh God.
Yeah,
Yeah.
this
No
is-
hockey pucks.
It's kind of like
Hey,
soccer.
but seriously, I like that analogy. Because when you're watching volume, you can tell when it's starting to dry up. You can see, you know, it's slowing down. You know, I remember when I first started trading, and I was talking with Charlie, used to preach about price action and volume. And it sounds crazy, but I can look at price action and volume without looking at a chart and kind of see support and resistance where it just keeps hitting a price and gets snuffed, keeps hitting a price and gets snuffed, or keeps bouncing off of a price. And, you know, you can see it drying up, how the slower it, the longer it lasts at that price, or, you know, sits there for a little while. You know, you can also see with volume coming into a chart, you know, when you see that volume drying up, maybe it's time to take profits.
And you
know,
see
so I
it
feel
too
you.
when
I
it's
feel-
holding price levels. You see it when it's pushing them, or it's holding them, or it's rejecting them. You start
Yeah.
to see how it reacts. If it jolts, or it continues the flow of, like, you know, whatever the energy is that's pushing it.
Exactly. No,
Yeah.
it's a good analogy. I like that, man.
But take your popcorn and enjoy it.
Yeah, exactly. Take your popcorn and enjoy it.
Yeah, we get that in the comment section a lot, is that, oh, I got out for $1,000 profit, but it should have been 1,500. So using that, did you get more kernels popped versus more that you had but turned into burned kernels?
Yeah, and if you go too long, it'll burn your popcorn.
Yeah, so you can never really get out of a trade that's profitable and then say, oh, I should have held. Because if you got out for a valid reason, you got out because something told you to get out. Unless you're just
Yeah.
like, oh shit, I'm scared, and you hit the button, which we've all done. I was doing that 2 weeks ago when this whole volatility started. I saw a profit and then it would disappear, and then I'd see it again. I'd say, fuck it, I'm locking it in. Boom. There wasn't necessarily a point on the chart that said to, but I had profit, then it disappeared, then it came back. So I'm like, all right, I'm just going to lock this in and figure out what's going on with the market here. So we've all done that. As long as you have a valid reason to get out, you can't really go back and say, oh, if I held this, I would have had so much more money. Because, yeah, of course you would. But what if you held it and it reversed and you lost all that money? So as long as you have a reason to get out of a trade, I'm in the camp that says, don't go back and look at what you could have made. Now, we've all done it. I've had points where I've been in trades, and then at the end of the day, I pull up the chart and I'm reminded that I'm in that trade or was, and I'm like, holy shit, I screwed that one up because I'm in the trade. So there's a record of it on my screen. And then I pull up the chart at the end of the day, maybe doing research for tomorrow. And I'm like, oh, wow, did I screw that one up? So yeah, we all do it, but I'm never really mad at the fact that I got out for $4 and then it ran to $6.20, because that's just part of training. Did your popcorn pop, and did you grab the popcorn before it burned? You did a good job then.
Exactly.
Junkie, your hand is up. What's up, Junkie?
So a while ago when I first came back to Black Box, you'd given me advice about trying to close out trades into strength. And I think that it's helped me so much because I don't look to I don't wait until I'm fearful, or like I don't wait until I'm watching the trade that's incredibly green go incredibly red. Like if something's getting some great strength on it, I want to be able to like close it out while that's still there. And it's helped me get such great fills getting out of trades.
Yeah, so selling into strength, sometimes people don't like to do that because it's winning, winning, winning. You're like, well, why would I sell it now? If you're in a call and you're selling it on a green candle, you're going to get a better fill than if you wait for it to reverse and then you're trying to get out of it. You're going to get a much worse fill. But you have to have that, again, there should be a reason why you're selling. So if you're selling into strength because there's a nice big Roman candle that just shoots up and you exit, that's a good reason, because there's a good chance that big, huge candle is just going to reverse and come back down. If you're just been trending up all day long and all day and all day, and it just doesn't seem it wants to stop, the first section where you find resistance that looks like it's going to stop, if you're selling it at that point, you're going to get a better fill and you're going to feel better about the trade than if it hits that point and then it starts reversing. And now you're losing a little bit of your profits and you're like, okay, well, I guess now I'm going to sell. You're selling it on the way down. You're not going to feel as good and you're not going to get as good a fill than if you were to sell as it was going up. So it's a fine line between doing that and figuring out, okay, well, it keeps going up, so where do I sell it? So yeah, that's something that comes with experience there, but you'll find you're going to get better trading overall if you're selling into strength versus selling it when it hit a resistance and then starts reversing against you. But again, you have to have that reason to sell. Don't sell just because something's going up. You've got to have a point where you're comfortable selling where, okay, it met what I thought it would do. And then you want to watch to see if it's going to have continuation beyond that. So don't just sell because something's going up. But when you start getting a feel for this is a good place to sell, and you sell as it's kind of going in the direction you want it to go in instead of waiting for it to reverse a little bit, you're definitely going to get better fills and capturing more of that trade. Who else does that? Is there anyone that basically sells into strength? Has that been hard to learn?
I like to sell into strength. Mike, it's Ty again. I think it's a good thing to try and do. You know, selling into strength, you're going to get a nice profit out of that. And not that you're not going to get a nice profit out of, you know, riding a trade out, but when you get those real strong moves, sometimes it's nice to take some off the table, especially if you have, you know, 4 or 5 contracts, you know, take 2 or 3, let one ride.
Yeah, that's definitely the preferred method.
Oh, sorry, just to kind of add to that. I mean, I agree, but I think that selling into strength works better in a call than in a put, right? Like when you get a big green candle, like you said, it's likely going to be some kind of pullback, right? But if I found that in a put, when you have a big drop, chances that the next drop is even going to be lower, right? So it's kind of hard to make the call and say, okay, you know, this is a good place to take a profit when, I don't know, I maybe anybody else has the same experience, but I feel like in a call, it's easier to do that than in a put, so to say.
You still want to do it when you're in puts because again, you're selling it in the direction that it's going. So that's the strategy and the technique. Now, when we have days where we're just dropping 1,000 points for the day or like 2,000, then yeah, when you get a huge red candle and the next one's just as huge and the next one's even bigger, it's hard to determine where do these huge red candles stop.
Yep.
You still want to find that point where you're comfortable selling, like it's approaching a support line and then it's maybe pausing.
Okay.
Versus letting it hit that support line and then it reverses $3 against you in the other direction. But yeah, when you see these huge red candles on a day when we're down 1,500 points, there's a good chance you're going to get more big red candles for sure.
Yeah.
And that goes with the market. So right now, like when we have these huge back-to-back down red days, yeah, puts are going to work out a lot more better than calls. When we have those solid up days, you know, a call is going to be better than puts. And selling into strength is just, it's easier to do when you're in that direction. So if you're in a call on a deep red day, it's going to be harder to sell into strength. If you're on a deep red day and you're in a put position, it's going to be easier to do. But yeah, like you said, like you don't want to just see a huge red candle and sell it because the next one might be just as big. So part of that comes with experience. Part of it comes with knowing support and resistance levels where we might have 4 or 5 huge red candles. And then where do you expect it might stop? So if you're close to a support line after 4 big red candles, that might be enough to say we're approaching a support. I'm not going to let it turn against me. I'm going to sell here. preferably, if you have 5 contracts, you sell 1 or 2 there. And then if it's going to break that support and keep dropping, you still have 3 of your position or something like that. So you're selling into strength, but you're not closing your position. You're just slowly unwinding it a little bit each time it gets to a new level down, which is kind of similar to if you have a single contract, you're bumping up your stop loss. So as you get more profit, you bump up your stop to protect that profit. That's kind of the same idea as far as you have 5 contracts. You get to a support level, you sell 1 or 2, so you lock in those profits. But if it continues to go down, you still have some of your position. And then it drops to the next level, maybe you sell 1 or 2 more. So you're locking in even more profits. But if it continues to go down, you still have a portion of that position. And then it's just a matter of how big is the position to the point where, do I sell 2 here? Do I sell 5 here? And that just comes with some experience in figuring out what works best for you. But yeah, don't just sell because you have a super red candle on a day when we're down 2,500 points, because the next candle might be just as red.
Yeah, cool. Thank you.
Another thing too is if you're selling into strength, it means you have buyers on your side. So it's like piranhas, so you can sell them. If you're doing leverage, that helps.
Exactly.
Sell your contracts into strength. If you're selling them into weakness, you might be waiting or arguing with the bid or the ask, or maybe not hitting, the mark.
Yeah, if you're doing a market order, you definitely want to sell into strength. If you're doing a limit order, it changes a little bit. But if you're doing a market order for a call as you're on a green candle, you're going to get a much better fill than if you're doing a market order for a call after you've seen the first red candle after resistance. But again, that's personal preference. I use market orders all the time. I know people that will, if there's a 3-cent spread, they still won't do a market order. So it's a different strategy depending on what you're comfortable with. So again, is market order versus limit, is one right or wrong? No, one's right or wrong for me, one's right or wrong for you. So the idea is the same, but you might adjust it a little bit depending on your trade style. So there's people in the room that are in the same trade I'm in, and they're going to make more profit than me because I'm looking at a different type of a trade. I'm looking to get in and get out and move on to the next trade. So there's people that will let it go against them for quite a bit. So maybe, let's say we're up $1,000 in profit, and then it retraces $150. And then it's going to 200 and then 300. So you're slowly losing profit. At some point, I'm going to cut that and lock in my profit, where someone else might let it retrace $400, $500, $600 and then see if it's going to go back in the other direction again. So the risk tolerance for me is a little bit tighter, where if I have a good profit, I'm not letting most of that go away before I see if a support is going to hold. So again, that just comes down to a different trade strategy as well. There are people that are going to hold longer than me because I prefer just short-term trading. I want to put my money in, grab some profits, and get it out. But I trade a little bit quicker than a lot of people. So what I do doesn't necessarily work for some people. And then the people that are going to be in the same trade but hold it longer, they might make more money than me on that specific trade, but I'm just more comfortable getting in, grabbing profits, getting out, and looking for the next setup. So again, that's just a personal preference on trade style. What are you comfortable with? What works for you? Junkie, what's up? Your hand is up. You got the floor.
So, I know this isn't what you guys are saying, but I just want to caution against doing this. When you see a big red candle, don't just assume because there's a big red candle and that we're already so far down that it can't go any lower, or vice versa, that it can't go any higher. Because that's the kind of rationalization that gets you into the huge losing trades that you want to avoid.
Yeah, so it's one of those things where we try not to, and I guess the best traders don't anticipate anything. They just watch the chart and let it tell them what's actually going on. So we've learned Maria has this thing where, and when we say don't chase Roman candles, the reason for that is because when you get these monster candles, typically it retraces a little bit. So if it's a monster red candle, typically you're going to see some green candles after that. If it's a monster green candle, typically you're going to see some red candles after that. So when we say don't chase it, is because let's say something pops from $50 to $52 and you go, holy crap, that was a huge candle, and you're in at $52, chances are it's going to come back to 51, maybe $50.80. And if it's going to climb, it might still climb after that. But there's usually a point where when we see those big giant candles, at least a little bit of that comes back. when we say don't chase the Roman candles, it's because a lot of times we'll see something pop huge, but then it slowly gives it back. And then from there, it's either going to go up or down. We don't know, but typically we'll see some of that come back. In this market, again, being as crazy as it is, we've seen some things pop and then just run the whole rest of the day. So again, it comes down to experience of seeing this happen over and over and over, to being able to figure out, is this pop sustainable, or is this something that's likely going to give it back? We've seen both. We've seen a headline come out and then the market for the last 20 minutes of the day just runs. We've seen a headline on Boeing where it's dropping, and then a headline for Boeing comes out, it pops maybe $7, and then the whole rest of the day it just bleeds that whole pop off. So a lot of it isn't, and this is for me, a lot of it isn't trying to figure out what's happening, but more just kind of watch and see what's happening. Is there a continuation or not? And that's just something the charts are going to tell me, but I'm not always right when I do that. So it's not gospel of what I'm saying here as far as how to trade. But typically we say don't chase those Roman candles because a lot of times we see them come back. But like you said, there's no guarantee that they're going to retrace at all. You can see a Roman candle, not get in because you're thinking it's going to retrace. And then the whole rest of the day, it runs in the same direction as that Roman candle. And you're like, oh man, I could have had a $17 move, but I didn't chase it.
Yeah, but most of what I'm trying to caution against, if anything, is just don't get caught in the, okay, this trade's going against me, but that's a huge red candle, so I shouldn't close it out. Sometimes if something hits your stop, especially now, especially if you're trading towards the end or beginning of the day, you can get big moves that take you out really hard. So I would just try to exercise best judgment, and follow your trading plan. The size of candles is generally not a great way to determine when or when not to stay in a trade, but as far as closing trades out, sometimes letting stuff run is great, and then other times you want to just take the wins that you have and realize that you're not going to be able to 100% of the time find the top.
Yeah, my advice would be 100% of the time you will not find tops and bottoms. So as traders, we're not going to time the market any better than JP Morgan that might have billions of dollars of computers at their disposal. If they can't time the tops, what makes me think I can with my $1,000 HP computer off the Best Buy shelf? So yeah, we're definitely not going to time tops and bottoms as long as we're grabbing pieces of that. And like he said, definitely adhere to your stop losses. And on that note, we're approaching the 2-hour mark, so we're going to wrap this up. Does anyone have any closing comments on what's been going on with the craziness? The floor is yours. You've got a few moments here. Absolutely crazy, volatile times we've been in for the last 2 weeks. So in the chat section, are you guys surviving through this, or is it destroying you, or are you completely excelling and destroying the market? Leave some comments in there, and if anyone has any closing comments on the craziness of the market that we're seeing, jump in now, and after that, we're going to go ahead and wrap this up for the night. So if you have any comments, now's the time. Get them in. If not, I want to thank you guys for joining me tonight. I love the flow of information. Like I said last time, I think we're going to do this somewhat regularly, every other week for now. If there's a specific topic you guys want to discuss or have a bunch of minds talking about, send me a message on Discord, Twitter, Instagram, wherever. Just send me a message somehow and say, hey, you know what, I like the format, but can you maybe talk about this? Or I think the format can be better if we change it to this. So again, this isn't for me, this is for all of us. I love the participation you guys have provided. Please send suggestions so we can make this better. And if it's helping you, let's figure out a way to help as many people as we can. I don't see any other questions or comments, so thank you guys for joining me on a Sunday night. If you have further comments or questions, I am available through Discord, Twitter, Instagram, YouTube. Reach out, ask questions, give me suggestions on how to make this better, give me topics that we can do for next week. And on that note, thank you guys. Have a great night. I will see you guys at the opening bell tomorrow.